Hi, my name is Trevor Austin. I'm the founder of Authentic Life Financial Planning. In this video, we're diving into Stock Options 101. So let's talk about stock options. So stock options, have three of the same things as restricted stock. They have a grant date, they have a vest date, they have a sale date. But the fourth thing they have is they have that exercise date, which doesn't come into play with restricted stock, but it does come into play with stock options. So I'm going to move through this relatively quickly just because it is relatively similar as restricted stock. But on the grant, again, you're receiving the equity plan, you're receiving the grant award, the vesting schedule, but unlike restricted stock, you're also receiving the exercise price. Generally, that's going to be the fair market value on the day of grant, but that's not always the case. 9 times out of 10 it is, but that's not always the case. At vest, unlike restricted stock, nothing really has happened at that point. Really, the only thing that now exists is that you now have the ability to exercise those shares that have vested. So there's no tax on vest, there's no income earned on vest. Really nothing has happened other than your ability to exercise those shares. Now, eventually you do need to go ahead and exercise those shares, and that's where everything pretty much happens. So at that point, you receive ownership of the shares, and the bargain element, which is the difference between the current fair market value and the exercise price. That difference is what's included in your tax calculation for the year. It's also the value of the stock option at that point in time. After that, there's obviously going to be a sale at some point. And just like with restricted stock, you receive the proceeds after any transaction costs and any taxes are owed. So really the only difference is that exercise. Again, it just allows you to take ownership of the shares at that point in time. And yeah, we'll talk about exercising a little bit more. So there are three main ways to exercise stock options. There's more, but these are the ones that are most common. So the first one is the cashless exercise. With this type of exercise strategy, essentially you trade your stock options for cash. So you use the stock to pay the exercise price, you use the stock to pay any withholding, and then you receive any cash proceeds after the exercise cost and the taxes have been withheld. So in that case, you receive cash, you don't own the stock anymore. This is best used when the shares haven't appreciated significantly and you have a use for that cash somewhere else. Whether it's a life goal, you want to buy a home, you want to pay for college for your kids, whatever it ends up being, you can do that. You can also do this when you want to diversify out of this stock. So if you have some stock options and you also have restricted stock and you want to diversify, this may be a good way to build some diversification outside of your employer stock. The second main way to exercise is what's called a cash exercise. Now, this may be your only option if you work for a private company or a pre-IPO company. This may be your only option. That's not always the case. There's a lot of tender offers happening right now. And so you may be able to do a cashless exercise or a sell to cover right now just because of what the market is doing. But in general, you're likely going to have to do a cash exercise. All that means is that instead of using the stock to pay for the exercise and pay any tax withholdings, you have to come up with the cash yourself, which means you have to pay the exercise cost, which is just the exercise price times the number of shares. It also means that you'd have to pay any taxes that's based, due to that exercise. So if it's a non-qualified stock option, we'll look at the taxes in a little bit here. But that means you're paying compensation income taxes again. So federal, state, local, Social Security, and Medicare may all apply in that situation. The last way to exercise that's kind of most common is what's called sell to cover. Essentially, a sell to cover Exercise, it's a hybrid of the two. So it's kind of like a cashless, kind of like a cash exercise. Essentially, what happens is that you use some of the stock to pay the exercise price and pay the withholding, but then you keep the remaining shares after that. So as an example, maybe you have to take 10% to cover the exercise price, maybe another 10 to 15% to cover the taxes, maybe even more. Given my example, it's probably a lot more. But let's just say it's 15%. And so the remaining stock, 75%, would be held and you'd continue to be invested in that stock. The best reason for this is in between these. So it's either when the stock has appreciated, but you want to be invested in it, or it hasn't appreciated that much, but you still want to be invested in it, and you don't have the cash to pay for the exercise cost and pay the withholding, or you just have other uses for that cash. That this is just not the right use for that cash at this time. I realized I didn't talk about cash exercise. That's best used when the stock has not appreciated in value much yet, but you expect it to be, and you want to be invested in that stock. And as I said, with private and pre-IPO companies, this usually is going to be the only option. Again, not always the case. Companies do have a lot of flexibility in how they design their equity programs and how they do this, but in general, that's going to be your only option if you work for a private company. So let's talk about everyone's favorite topic, taxes. With this, as I said before, we're not going to talk about ISO taxation very much. I do have details on that on the slide, but I'm not going to spend a lot of time focusing on it just because it really does deserve its own time. So I'm not going to cover that here today. But I will talk about how non-qualified stock options are taxed and things to look out for with that. So with non-qualified stock options, again, that bargain element, so just the difference between the current fair market value and the exercise price, that difference is what's included in your tax calculation for the year. And with non-qualified stock options, it doesn't matter when they get exercised or if you sell, no matter what, you're paying compensation income, which means, again, federal, state, local, Social Security, and Medicare taxes could all apply on that bargain element difference, which can be a big deal. It can be tens of thousands of dollars, if not more, depending on what's happened with the stock since it's been granted until you've exercised. At the sale, just like with restricted stock, the difference between the fair market value when you sell and the price you paid when you exercise, so that fair market value when you exercise, that difference, that is what is included as a capital gain or loss. Again, if it's held for a year or less, it's short term. If it's held for more than a year, it's long term. Long term in general is better. But just like with restricted stock, most of the taxation that you're paying with stock options is going to be from the exercise. It's not going to be from the sale. That's not always the case. There certainly are exceptions where if you exercise early in your period before they expire, there may be a small difference between the exercise price and the fair market value when you exercise, and then if you hold them for a long time and it grows, then there may be more tax when you sell. But usually what happens is people wait to sell until it's grown a bit and then just exercise and sell all at once using a cashless exercise. Now that's not always the case, and that's not always the best practice, but that's a common way that people exercise, especially non-qualified stock options. So let's look at an example. So maybe Rich works for XYZ tech company. It's a large public tech company. She's received a non-qualified stock option grant before. She's receiving another one now. And so let's talk about her grant. So she has a target of $100,000. The current fair market value is $50 per share. And so she's been granted 2,000 shares of non-qualified stock options. The vesting schedule is 25% after 1 year, with the remaining shares vesting monthly over 4 years. So it's similar to the one we had with Will, but in her case, after the first year, the shares vest monthly rather than quarterly. So on March 4th, 2026, 500 shares vest, and then after that, 125 shares vest monthly after that. I haven't talked about vesting schedules too often or too much yet, but this is a pretty common one today. The other one where it's 25% after 1 year and the remaining vest quarterly after that over 4 years is also pretty common. That's probably two of the most common ones. Another common one that I've seen is 25% over 4 years, but they vest annually. So just March 4th, March 2026. 2027, 2028, and 2029 is when the shares vest. That one's pretty common. Another one is basically the same thing, but 33% over 3 years. That one's pretty common as well. But that all being said, companies really get to do whatever they want with these equity plans. They get to decide how much they grant. They get to decide what the vesting schedule looks like. There's a framework, from a tax perspective. The Internal Revenue Code, spells out what can and cannot be done. But beyond that, companies have a lot of flexibility in how they design their equity plans. And, one of the things is how they decide what their vesting schedule is going to be. So let's continue this example. We're talking about May Be Rich here. So same thing, she has her grant of 2,000 shares. The target was $100,000. The fair market value and the exercise price is $50 a share. And so let's see what happens on March 4th, 2026. The shares, or the current fair market value, is now $60 per share. So the question is, well, how much is the shares that are vesting valued to her? Now, the calculation with stock options, again, is a little bit different than restricted stock. With restricted stock, it's just, number of shares vesting times the fair market value equals the value. Where with stock options, there's another step. We have this exercise price that we have to account for. And so the calculation for stock options is current fair market value minus exercise price times the number of shares vesting, which means that in May's case, $5,000 is the value to her today. What that means is that, again, just the fair market minus the exercise price is $10. She has 500 shares vesting, so $10 times 500 is $5,000. So if she were to exercise, a year on March 4th, 2026, when the fair market value is $60 per share, those $5,000 is what would show up as part of her income tax calculation for the year. Now, depending on how she exercised, that could mean that she has 500 shares that she owns at that point. If she does a cashless exercise, it's going to be a lot less than that because she has to pay the exercise cost, which is $50 times 500 shares. So that's $2,500 if I'm doing my math correctly. Nope, that's not right. Anyways, $25,000. There we go. That's the right math. $25,000. So she'd have to pay $25,000, and then she'd have to pay the withholding on it after this, on the $5,000 after that, which means she'd probably end up owning, less than. I have not done the math. But likely well under 100 shares, probably around 50 to 80 shares, based on my rough math right now. But that's if she does a cashless exercise. Which goes back to what I said before, that a cashless exercise may not be the right plan if the stock price has only increased by 20%, which is a good amount in a single year. But that doesn't mean that it's enough for the cashless exercise to be worthwhile at that point. So let's look at another example. So same details overall. This time on March 4th, 2026, instead of the stock price being $60 per share, it's now only $40 per share. And again, the exercise price is $50 per share. It's still 500 shares that have vested. So the question is, what is the bargain element at this point? If she has a $40 per fair market value, exercise price is $50, and 500 shares have vested. The question is how much, what is an element? What will be included in her taxable income for the year? And as a reminder, the calculation for this is fair market value minus exercise price times the number of shares. Oh, and I realized I did not post a poll. I'm not going to do that since it's been a bit here. But if you were thinking it was $0, you are correct. With stock options, one of the they can be so valuable is because they are leveraged. And what that means is that there's this exercise price that acts as a fulcrum on the lever, with the stock price being on one end and the bargain element being on the other. And if the current fair market value is below the exercise price, those shares are then not worth anything. And the reason for that is because you can go out and buy 500 shares at $40 per share, which is obviously less than $50 per share, which means there's no value in exercising these shares because the current fair market value is less than that. You can just go out and buy the shares on the open market for less than what you would be paying if you exercise those shares. And so there's no tax benefit to exercising in this situation. There's no value received at that point. That being said, there can be tax reasons why you exercise when the fair market value is either less or equal to the exercise price. This isn't very common with publicly traded companies. I generally won't do it with publicly traded companies. But for private companies, that can make a lot of sense because you're paying on a bargain element of 0, which means you're not actually paying any income taxes at that time. But you're taking ownership of the shares. You're choosing to be taxed now on, again, nothing. But if the shares were to increase in value in the future, they could end up being worth a whole lot of money, which means you'd be paying a whole lot of tax. Again, I generally wouldn't do this with a public company. It definitely can make sense for a private company to do something like this, but that doesn't mean that that is what you should do. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.